All right, let's talk about marketable securities. Now we're still talking about investments. We just talked about cost versus equity. That was cost 0 to 20%, equity 20 to 50. Now we're going to talk about marketable securities, which again is still 0 to 20. However, there is a market value, fair market value. So as we look at marketable securities, we're going to see that there's different ways to account for them. So let's think back again for a minute. We said if it's 0 to 20%, that was called the cost method or marketable securities. If it's 20 to 50%, that was called the equity method or one-line consolidation, and 50% plus was consolidations. All right, so 0 to 20, 20. We've already talked about this and this. Now we're going to look at this one, which is marketable securities. What it says is we own 0 to 20. However, it does have a market value. In other words, it's traded on a national exchange, for example. Let's say, for example, I own 100 shares in Microsoft. So when I was single, I'd go out to the clubs and go, hey, can I buy you a drink? What are you doing? Hey, and they say, hey, what do you do for a living? I go, oh, I own Microsoft. They go, wow, you own Microsoft? You and Bill Gates, right? Well, Bill Gates owns like 30% worth $50, $60 billion, right? And I own 100 shares worth like $3,000. So obviously, but the point is, how much influence do I have? Same kind of rules. If I own 0 to 20% of the stock, I have no influence. That's cost, or in this case, marketable securities. But within marketable securities, there's different categories called trading, available, and held to maturity. You'll see here, top of the page, it says, when an investment is made in securities, debt or equity. What is debt? Debt, bonds. What is equity? Stocks that are publicly traded, and the investment is not large enough to provide the investor with any significant influence over the investee. The accounting for the investment will depend on the classification. This is covered again by ASC 320 or FASB 115. We got trading, available, held to maturity. Trading securities means this, and it's all based on the fourth paragraph down, management's intentions. So when I go out to the company, I pick up these statements. Whose statements are these? Management. I'm going to ask them, what are your intentions? What are you going to do with this stock? Well, some people buy stocks and bonds and they watch the market. I'm going to buy, I'm going to sell, I'm going to buy, I'm going to sell. And they call their broker, sell, sell, buy, buy, sell, sell. What is their intention? To trade it currently. So what does that mean? It is held for trading. We call that HFT, held for trading or trading securities. Another type is called available for sale, AVS. That means they bought a security and they're going to hold it for a while, but their intention is to hold it, but if they need the money, then it's what? Available for sale. So if they need the money, it's AVS. Held to maturity, this is for something they intend, they have the intent and ability to hold it until it matures. So for example, bonds mature, so that would be, for example, debt securities or bonds, so bonds only. Again, it says there, as a result, trading management's intention. So again, we have to talk to management and say, what do you plan to do with these securities? What are your goals? Now, trading securities, with trading securities called held for trading or HFT, it says when trading securities are acquired, they're recorded at cost. Since they're being purchased for the purpose of generating profits from resale, they're kind of a form of inventory, and transactions are normally reported in the operating section of a statement of cash flows. So we're going to have to learn kind of where do they go in a statement of cash flows as well, which we'll talk about in a moment. Let's jump ahead and kind of look at a chart. Now this is going to be a really important chart. It will benefit you and your life and your children and your children's children. Look at this chart on page 5. And it says there, trading securities, HFT, held for trading, available for sale, AVS, held to maturity, HTM. So what I want to do is kind of talk about these different securities and how we account for them. So let me set this chart up over here. And we're going to have what we call trading securities, which is held for trading. We have available for sale, and we have held to maturity, HTM. These are the different categories of securities that we could have. Now, as far as a trading security, as I said, your intention is to what? Trade it currently, buy, sell, buy, sell, buy, sell. So on the balance sheet, this is generally considered a current security. It could either be stocks or bonds. Now, what are stocks or bonds? Equity or debt. So it could be either equity or debt, equity securities being stocks, debt securities being things like bond. And we generally acquire it at cost, but we're going to carry it at its fair market value. So that's what we're looking at on the balance sheet. So on the balance sheet, current, it's considered a current security. It could be stocks or bonds, and fair market value. Now, I buy this security. My intention is to trade it currently. So how is this affected in the financial statements? Well, let's say the value, remember back in conceptual framework for accounting, we talked about recognition, realization. Recognition, realization. So I said if you buy a security, you haven't sold it, but the value goes up or down, that's an unrealized gain or loss, but it's recognized. So what we have to look at is if the value changes, we're going to have what these things called unrealized gains or losses. If it is a trading security, your unrealized gains or losses go on your income statement. So they go on your income statement. So on the income statement, if the value changes, called an unrealized gain or loss, that's going to go on your income statement. If you sell it, what kind of gain or loss is that? Realized. That would also go on your income statement. Now, what do stocks and bonds pay? They generally pay interest and dividends, right? Bonds pay interest and stocks hopefully pay a dividend. So if you have interest or dividend income, that would also go on your income statement. What about on a statement of cash flows? Now, we haven't talked about this yet. We're going to talk about it in the cash flow section. But generally with cash flows, generally speaking, when you buy or sell a trading security is normally considered an operating activity. Now, we're going to learn in cash flows in FAIR 6, we've got trading, we've got operating, investing, and financing. Operating is normal operations, how a company survives, buying, selling, and so on. Investing is where they invest in themselves or they invest in somebody else. They buy property, plant, and equipment, they buy securities and so on. They're making an investment. And then finally, operating invest. Financing is how you finance a company, how you get money into the company by issuing stocks, issuing bonds, things like that. So these are all different types of operating, again, on a statement of cash flows called operating, investing, or financing. Here it's normally operating. It could be investing as well, but it's normally an operating activity. And that's kind of relatively new that it could be investing, but it's normally operating. All right, as you look at available for sale. Now remember, with available for sale, Available for sale, this could be either current or non-current. Because available for sale means you bought a security, but what's your intention? Your intention is to hold it, but if you need the money, it's what? Available for sale. So this could be current or non-current, although it's usually current. It could be stocks or bonds, and you buy it at cost, however you keep it at its fair market value. So you can see here with AVS, again, current or non-current. Now notice, non-current, generally AVS. Current could be held for trading or could be also AVS. Now here's the big difference. This box right here, this thing here, that's going to go up here in this top part. So if you have an unrealized gain or loss, it goes on the balance sheet as part of comprehensive income, which is part of equity. So when I teach you this mnemonic, which is going to be DENT, D-E-N-T, on your stockholders' equity, it is going to be the N, which is your net unrealized gain or loss on available for sale. So the big difference is this thing here, your unrealized gain or loss goes on the balance sheet, not on the income statement. So it's going to go on the balance sheet, not on the income statement. Now, what about realized gains or losses? Yeah, those still go income statement. What about interest to dividends? That still goes income statement. And generally, when you buy or sell this available for sale, it is an investing activity on your statement of cash flows. Okay, so that's available for sale. So that's the big difference here, which I'm going to show you because that they love to test. Finally, held to maturity, I'm not going to cover a lot today because I'm going to cover a whole different section on bonds in a separate topic. But held to maturity, if you look around page 5, this is where you buy a security, but your intention is to do what? Hold it until it matures. So this could be current or non-current because you could have bonds that you bought 10 years ago that mature in a week, current, or they mature in 10 years, non-current. This is bonds only, or what I'll say is debt only. Why is that? Because let's think about it. Bonds mature, stock doesn't. Here's a quick question. What's the difference between a bond and what's the difference between a bond and your boyfriend? Bonds eventually mature. Love you, mean it. All right, so there you go. So what does that say? Bonds only, which is debt, so that's held to maturity. Basically, this is kept at something called amortized cost. Now, amortized cost, again, I'm going to cover in detail when I'm teaching you bonds, but it's basically cost net of unamortized discount or premium. So as we go through, that's called amortized cost. So let me have you highlight that third bullet down, carry at amortized cost, face net of unamortized discount or premium. Now what do I mean by this? One of the things that I'm going to be teaching you, and look over here, is when I issue bonds payable for $1,000, let's say I got cash of $900, so we have a discount of $100. That's the journal entry when you issue a bond. What's going to happen is, as we go through this, we're going to have to see that you're amortizing it out. So as I teach you this in the bond section, is we're going to have some kind of cash that we're paying. We're going to amortize out the discount, and our plug will be interest expense. So you'll notice that the amortization of the discount increases our expense, but we'll cover that in a separate section. This is from the person who's issuing the bond. The person who's buying the bond would do this. They would debit investment in bonds for $1,000. They would credit cash. They only paid $900. They too would have a discount of $100. Now, the investor would keep this investment at what we call amortized cost, face net of an amortized discount or premium. So in this case, it would be $900. And let's say it was a 5-year bond. They're amortizing at $20 a year. So this would come out by 20. This goes down from $100 down to $80. Now it goes up to $920, $940, $960. $980, and then $1,000. So that is what we mean by amortized cost, face net of unamortized discount or premium. I'm going to spend a lot of time on bonds, generally from this perspective, the issuer. However, we need to understand both sides. But in this section, this is not as heavily tested. This goes over here with held to maturity. However, what we need to understand is the distinction between all three of these. So we need to know what is trading, what is available, what is held to maturity, and kind of the differences between all of them. So here's what I've covered so far. If it is a held to maturity, that's bonds only, current or non-current, amortized cost, cost net of discount or premium. Generally with held to maturity, you really should not have any kind of gain or loss until you sell it, right? Because you're going to hold it till it matures. But if it does occur, which is rare, you could have a realized gain or loss. You also would have interest income. When you buy or sell a bond, it is going to be what? An investing activity. An investing activity on the statement of cash flows. So I'm covering cash flows in another section, but I'm just trying to kind of introduce you to it right now. So for today, we're going to really focus on these two more so than even held to maturity. So we need to understand this chart because it is very important as far as conceptually. Here's the big thing I want you to see. What I want you to realize is trading versus available for sale. Trading, stocks or bonds, current, fair market value. Here, it could be current or non-current, stocks or bonds, fair market value. Here, an unrealized gain or loss goes to the income statement. Here, an unrealized gain or loss goes to the balance sheet. The other thing, too, is if it's non-current stock, it can't be this, it's generally this. So on the exam, if it's current stock, it's usually this. Non-current stock, usually this. If it's bonds, it could be this or this or this. Okay? So that's what we're going to see as far as going through it. So let's turn back in our notes. Look back to about page 2, and let's do a class example. Because I want to walk through it because I want to make sure that you're understanding the concepts here. So let's go through this class example and kind of see what's going on. All right, it says here, class example, purchase price on 1/1x1 for $100,000, 12/31x1 140, 12/31x2 went down to 90. All right, so we're going to go through this problem. We're going to do both trading and available for sale. That's what we're going to do over on this board. So let's start out here with trading, and then later on we'll do available for sale. So when I purchased this security, I debit investment, and I paid, what was it? I paid $100. Debit investment, credit cash. Okay, so that's the investment. Now, here's my investment T account. $100. Then it says in X2, in X1, it went to 140. So at the end of the year, it went to 140. So now I want it to be 140 in value. So what I will do is I will allow for the increase. 100 plus 40 is 140. That's my target. I'm going to adjust it to my target, my target. So 140. Now, is this a realized or unrealized gain? I haven't sold it, so it's what? Unrealized. So what did we learn? If it's trading and it's unrealized, it goes where? Income statement. So for X1, my journal entry is going to be debit allowance for 40, credit unrealized gain for 40. Now this unrealized gain goes where? Income statement. The next year it goes to 90. Value goes to 90. So my new target or target is 90. So at that point, 100 minus 10 is 90. So that I need a goal of a credit to 10. How do I get it there? 50. That's my journal entry. So over here for X2, what's my journal entry going to be? I guess I credit allowance for 50 and I debit unrealized loss for 50. Now notice, where does the unrealized loss go? Both of these go where? Income statement, income statement. How do I know? Because it's trading. So again, notice I bought it for 100, it went up to 140, 140 debit allowance, credit unrealized gain, income statement. Then it went down to 90, what do? Credit allowance, take it out, and hit a loss. Where does the gain or loss go? Income statement. So let's look back over here again, and let's kind of look at my chart. What does it say? Trading, current, stocks or bonds, put it in, you want it at cost, carry it at fair market value. The value changed, unrealized gain or loss goes where? Income statement. Okay? And again, the concept is it goes to the income statement. Why is that? Because your intention is to hold it currently, to trade it currently. Therefore, the gain or loss goes to the income statement. So what I want us to realize there is the gain or loss goes to the income statement. Look at the journal entries in your notes. To purchase it, boom. Then it goes to 140, boom. Then it goes down to 90. If we have a loss or gain, that goes to the income statement. Note, look at the note. The income statement effect in X1 is 40 and in X2 is negative 50. These amounts represent the current year effects only since they're both income statement items. Here's what I want you to realize. There are certain items that, when you think of an income statement or balance sheet, an income statement is what? It's a picture of the company this year only, this year only. Because remember, income gets closed out to retained earnings. Whereas a balance sheet is what? Cumulative, cumulative, cumulative. I started the year with $100. I made another $100. How much do I have at the end of the year on my balance sheet? $200. How much did I make for the year? 100. So that 100 is my income statement number, which flows this year's number only, but balance sheet is cumulative, cumulative, cumulative. So because these are income statement item numbers only, those are cumulative, therefore they go where? They're going to my income statement, income statement. Let's do the same question. Instead of trading, let's do available for sale, AVS. All right, so what I do is I go out and I buy the investment, debit investment for 100, credit cash for 100. Then at the end of X1, what happens? The value goes up to 140. So it goes up to 140. Now when it goes up to 140, what's happening here? Is it realized or unrealized? Unrealized. So debit allowance for 40, credit unrealized gain for 40. Now this unrealized gain, this is an available for sale security. So therefore it goes where? It goes to the balance sheet. Balance sheet as part of comprehensive income. Then the next year, what's going to happen? The next year in X2, it goes down to 90. So that's my target. So therefore, what do I do in X2? I'm going to have to debit unrealized loss and credit allowance. Now, remember, where does the unrealized go? The unrealized goes to the balance sheet, the balance sheet. So the unrealized goes to the balance sheet. So that's balance sheet, boom, that's balance sheet. Now remember, an income statement is this year only. A balance sheet is cumulative. So if the balance sheet's cumulative, then what do I have after 2 years? I have a gain of 40 and a loss of 50. These are balance sheet accounts. It nets out to what? 10 negative. This goes to an account called OCI, which is other comprehensive income. So what it means is it goes to this balance sheet account, part of stockholders' equity, called OCI. That is, remember the mnemonic DENT, which is comprehensive income, D-E-N-T, derivative cash flow hedges, which is the next chapter, excess amortization on pensions, FAIR 4, net unrealized gain or loss on AVS goes to the balance sheet, and T, foreign currency translation adjustments. So notice it goes where? On your OCI, N goes to stockholders' equity. So again, the big difference is back over here, this is income statement, this year only. This year only. X1, $40. X2, $50. Over here, what is this doing? Over here, this is going to be balance sheet and balance sheet. They offset. So your cumulative is going to be what? Balance sheet. So that's why coming back over here, your AVS, current Stocks or bonds, fair market value. Unrealized gain or loss goes on the balance sheet as part of comprehensive income, as part of your DENT, which is part of OCI, called other comprehensive income. You'll see this in your notes. Let's actually turn back to page 1. Look back at page 1. And on page 1, the bullets at the bottom of the page, it says, trading securities are purchased for the purpose of selling in the near term. They are current assets on the balance sheet if operating, and if investing, then non-current. Include both debt and equity. Initially record at cost but carry at fair market value. Any unrealized gain or loss temporary appear on the income statement. Now I mentioned the word temporary. Why? Because when you buy stock, how often does the stock price change? Like every second? Right? You're watching channel 58 and you watch the numbers go by. What is it? Buy, sell, buy, sell, buy, sell. Right? It changes every second. But those declines and increases are generally considered temporary. So normally you're going to allow, that's why we hit an allowance account, you allow for them to come back and forth. Versus in a few minutes we'll talk about like an impairment loss or a non-temporary permanent decline. That's when you would write it down and actually hit the investment. But otherwise you normally hit the allowance, because if it's temporary you're allowing for it to come back and go back and forth. The next bullet there, it says any unrealized gain or loss goes on the income statement. Realized gains or losses are always on the income statement. The acquisition or disposal is normally operating on the statement of cash flows. Although it says per SFAS 159, trading securities can be classified as either operating or investing based on the nature and purpose for which the securities were acquired. Normally, if current, then they're normally operating. So you could have a non-current trading. It's rare, but you could. Again, normally it's going to be an operating activity. All right, let's look at available for sale. Look at the bottom of page 2, 3. It says available for sale securities, debt or equity, current or non-current. There include both debt and equity. Initially recorded at cost, but you're going to carry at fair market value. Circle the next bullet. Any unrealized gains or losses appear on the balance sheet as part of comprehensive income. The cumulative amount is called accumulated other comprehensive income, which I'll show you in a minute. Realized gains and losses are always on the income statement, as well as interest and dividends. The acquisition or disposal of AVS investments in an investing activity on the statement of cash flows. So that's the journal entries right there. You'll see on page 3 to purchase it. Fair market value goes to 140. Fair market value goes down to 90. So those are the amounts there. Then it says, note. The unrealized gain in X1 is 40, is called other comprehensive income, OCI, and in X2, 50. However, the net unrealized loss in X2 on the balance sheet is only 10. Since it is a balance sheet account, we're concerned with the cumulative balance, and this amount is called what? Accumulated other comprehensive income. So then I added kind of an income statement there. So let me kind of set up this income statement right here so we can understand what it looks like. And here's my GAAP income statement. Now remember, I had a GAAP income statement. I said, what is it? I like to go surfing on the tide, OC, which is operating, non-operating taxes, discontinued, extraordinary, net income, other comprehensive income, comprehensive income. So I've got operating, non-operating taxes gives you income from continuing. Discontinued, extraordinary gives you net income. Then I've got OCI. What's OCI? DENT, other comprehensive income, which gives you your comprehensive income. So let's say we're looking at this GAAP income statement, and let's say we're looking at here's X1, here's X2. So let's go through and look at this to compare it. All right. So the first one, I'm going to do this example. So just from here back, remember this example, here back, which is for trading. So for trading, you buy it, investment 100, then it goes up to 140, allowance unrealized, then it goes down. So where do these two numbers go? Income statement. Where would they go on the income statement? They would go up here as N, other, non-operating. So in X1, I have a gain of how much? I have a gain of $40. In X2, I have a loss of how much? A loss of $50. So notice they go up here as part of your GAAP income statement. And that's the picture I put in there. It says if trading goes here. Now, instead, let's pretend it is available for sale. If it's available for sale, it doesn't go here. It goes down here as part of comprehensive income. Because comprehensive income is what? Comprehensive final in school was what? Scary, all-inclusive. Comprehensive income is what? All-inclusive. So it's net income plus more. So that's why your comprehensive income is net income plus or minus OCI, which gives you, so it's plus more. So let's come over here and look at this example. Now when we look at this, we've got available for sale. Debit investment, credit cash, then debit allowance, credit unrealized, then debit unrealized, credit allowance. Where does this unrealized gain or loss go? Balance sheet as part of what? OCI, other comprehensive income. So let's see how this differs. Let's say, for example, in X1, so instead of trading, it goes down here, available for sale, 40 and 50. Let's say in X1 we had $100 of net income, and in X2 we had $200 of net income. So what is other comprehensive income? For X1 it's going to be 100 is net income because this didn't show up there because it was available for sale. Then we've got $40 of OCI gives me 140. Over here, X2, 200 of income minus 50 is 150 of comprehensive income. Now what is this word comprehensive income? It shows up only on a comprehensive income statement. Because the way we can show comprehensive income as part of an income, it could say statement of income and comprehensive income, or it could be a comprehensive income statement just starting with net income and going to this. But here's where it shows up in the financial statements. Watch this. Net income plus net income is 300. That goes to where? Retained earnings. That's where income gets closed out into. We've got OCI of 40 minus 50 is 10 negative. Where does that go? That also goes to the balance sheet as part of stockholders' equity as part of accumulated other comprehensive income, or what we call accumulated OCI. So notice that. Then the net of that is your 290. Now in reality, this 290 that doesn't really show up anywhere. However, the 300 minus 10, these show up separately. Retained earnings is 300, other comprehensive income is minus 10. The net is 290. So what I want you to realize is this is what shows up. Why does the net show up? Because it's cumulative. Balance sheets are cumulative, cumulative, cumulative. Income statement is this year only, this year only. So that's the real difference between the two as you go through it. So you'll kind of see that example I put in there. So when you're doing problems, you've got to read them carefully. Are they asking for OCI for X1, OCI for X2, or accumulated OCI for X2? That would be the negative 10. So this is OCI X1, OCI X2, accumulated OCI. What number shows up? Accumulated OCI shows up where? In the balance sheet as part of stockholders' equity. Okay, so again, I understand that's a little confusing, so make sure we understand that. All right, then it says sale of AVS security. It says when an investment in AVS is sold, the difference between the cost and the proceeds is treated as a realized gain or loss. So when you sell an AVS, obviously it says here realized. Now, when we sell it, we ignore the allowance account and adjust to the new target balance without the security that was just sold. Unless it is the last investment, then the allowance and the unrealized gain or loss must both be eliminated. So what they're kind of saying there is that when you sell an investment, what we need to do is we need to see how that affected it. And basically, if it's not your last investment, you ignore the allowance account because in a sense, the allowance account is self-adjusting. So what I want us to do is I want us to understand that concept. And basically, what we're saying is if I had, let's come over here and look, let's do an example. Let's say, for example, back over here, my AVS. I'm selling the AVS. So I bought an AVS, and let's say, for example, I had more than one. So here's an investment. I had 100, and then I bought another for 50. That's 150. And let's say the value is 180. So how do I get that? I'm going to allow, boom, boom, here's 30. 150 plus 30 is 180. Okay? Now, let's say I sell just this one investment. Now, normally for AVS, as we just covered, for available for sale, normally what's happening? Normally when you sell or when you have an available for sale, an unrealized gain or loss goes to where? Balance sheet, comprehensive income. This says that when you sell it, when you sell the security, and here my example is AVS, available for sale. When you sell this security, you're going to debit cash. Let's say I sold it for 60. You're going to credit investment for cost, 50. Your difference is a gain or a loss. Now, what kind of gain is this? You sold it. It's called a what? Realized gain. It's a realized gain. You realized it. You sold it. But what about the allowance? Let's say they told you that of the 50, 10 of this was allowance. Guess what? You ignore it. Huh? You ignore the allowance. Why? Because the allowance is self-adjusting. Because what you'll do then is you'll say, okay, I got rid of 50, I'm left with what, 100. How much is that $100 security worth? Let's say it's worth 125. How much do I have? 100 plus 30 is 130. I want 125. I better take out 5 to get me to 25. How do I do that? Credit allowance, debit unrealized loss. So when you do this, notice it's self-adjusting. How is it self-adjusting? Because it adjusts because you only have that one security left. Therefore, it self-adjusts. Now, obviously, if I sold it and it was my last security, then you have to offset the allowance. But if it's not your last security, then this unrealized gain or loss you ignore, the allowance you ignore until you sell it. Let's read that sentence again. It said, when the investment in AVS is sold, the difference between the cost and the proceeds is treated as a realized gain or loss. Ignore the allowance account and adjust to the new target without the security that was just sold. Unless it's the last investment, then the allowance and the unrealized gain or loss must both be eliminated. All right, so let's do a couple of questions in the back of this section. And actually, before we do, let me just show you a little bit about where this stuff shows up. If you look, first of all, on page 3-3, on 3-3, that's where we went through and we looked at our balance sheet. So let's go ahead and look back again at page 3-3. So on 3-3, let me kind of put a little mark here. 3-3. Here we go, balance sheet. You'll see there it says short-term investments, marketable securities, trading. That's an asset. Then we've got non-current assets available for sale, held to maturity. So you can see those there, seeing how they show up. The other thing I want to show you is if you jump to page 17-6, you'll see an example of a statement of comprehensive income. On 17-6, it says, Roger Co. Statement of Comprehensive Income, net income. Then you have your OCI. What's OCI? Other comprehensive income. There's that mnemonic going down the page, DENT, which is derivative cash flow hedges, which is excess adjustment of pension PBO over fair value. That's for pensions. We haven't learned yet. Net unrealized gain or loss on AVS. That's the one we're talking about. Yellow that in. And translation adjustments is comprehensive income. So that is called your OCI, other comprehensive income. If you look at page 15-1, 15-1, that's stockholders' equity. Let me show you what your balance sheet or your stockholders' equity looks like. Remember, your balance sheet is assets, liabilities, and equity. What does equity look like? Preferred stock, common stock, APIC, non-controlling interest, that's for consolidations, retained earnings, accumulated other comprehensive income. There's your DENT. What is it? DENT, derivatives, excess amortization, net unrealized gain or loss on AVS, and foreign currency, and then treasury stock. So notice that's the accumulated. So in this example, remember the 10,000 negative? That's the cumulative. That shows up where? On your balance sheet. That shows up on your balance sheet as part of stockholders' equity. Hopefully lights are going on. All right, let's look at a couple of questions. Let's go back to chapter 5. Let's look at question number 1 and 2. Question number 1 and 2. All right, question number 1 says, NOLA has a portfolio of marketable equity securities that it does not intend to sell in the near term. How should NOLA classify these securities, and how should it report unrealized gains and losses from these securities? Now, it says marketable securities it doesn't intend to sell in the near term, so that sounds like non-current. So over here, let's look at our chart. What does that sound like? Non-current sounds like current, non-current sounds like available for sale, sounds like unrealized gains or losses go where? Balance sheet versus income statement. Okay, let's look back. Classify as trading? No. Classify as available? Yes. And separate component of other comprehensive income? Yes. OCI, other comprehensive income, goes where? On your balance sheet as part of equity. Trading? No. Available component of income? No. Best answer is B. Number 2, last sentence first. Ball's X3 other comprehensive income would be. So how much is their other comprehensive income? How much is their OCI? It says, data regarding Ball Corp's available for sale securities are as follows. December 31st, cost 150, went down to 130. X3, 150, went up to 160. Differences between cost and market are considered temporary. Why do we care? Because if it's called non-temporary or permanent, then you would write down the security. But usually we consider them all to be what? Temporary, because there's a chance we could recover it. So it says here, they want to know, now here's the tricky question. Are they asking for this or this? This or this? What's the difference? This is called OCI. OCI. Accumulated OCI. So what are they asking for? It sounds like OCI. So let's see our journal entries. In X1 we bought it for 150, went down to 130. In X2, X3 went up to 160. So let's set it up over here again. Bought it for 150. By the end of the year, it went down to 130. I have a $20 credit. How do I get it there? Let's see. Credit, allowance, debit, unrealized loss, 20. Where's that go? Goes to the balance sheet. The next year, the value goes to 160. 160. What's my new target, my target? I want it to be 10. Therefore, I need to hit this for 30. Journal entry, debit allowance, 30. Credit unrealized gain, 30. Now, where does the unrealized loss, unrealized gain go? Go to the balance sheet. So if I were looking over here, what would I have? In the first year, I would have a loss of 20. In the next year, I would have a gain of 30. The cumulative would be 10. Look at your choices. 30, 20, 10, 0. Oh my gosh, every choice is there. You better know what they're asking for. It says again, balls X3, other comprehensive income. They want to know your OCI for the second year, for X3. So your second year OCI would be what? That would be X3's OCI, 30. If they ask for accumulated OCI, then the answer would be 10. But keeping in mind, they're asking for this. Okay? They're asking for this. Okay? So that's what we're looking at as far as those two questions. All right, let's turn back in our notes and let's talk about impairment loss. Now, here it says impairment loss other than temporary. What does that mean? It means that all the losses, we said they're temporary, they're temporary, they're temporary. Well, anytime it is other than temporary, that means we don't think we're going to recover it. Now, they had to come up with reasons and rules that said in debt or equity securities classified as trading, available or held to maturity, or under the equity method experience a loss. So it could be the equity method as well, which we talked about in the last chapter. This is considered other than temporary. Then the security must be written down to the new cost basis and treated as a realized loss. Now remember, I haven't sold it yet, but what happened is we don't expect to recover this loss, therefore you write it down. For example, they just did a study and found out Mountain Dew causes cancer. Let's pretend. So if that's the case, what do you expect the value of the stock of Mountain Dew to do? It should drop, right? Unless it's cigarettes. Somehow they go up, right? William Morris just keeps going up. So the thing is, that would be a loss other than temporary because it's not just a fluctuation in the day-to-day market. We think it's a loss we're not going to recover. You don't do this unless they tell you in the problem it's permanent or non-temporary. So that's called permanent, non-temporary, or an impairment loss. It says here the security is written down at fair market value. The loss is treated as a realized loss on the income statement, and the remaining balance is considered the new cost basis. So that would be the new cost basis, debit, loss, credit, investment. It says the three-step process to determine the adjustment is 1, determine whether an investment is impaired. So in other words, is the value impaired? Is the fair value less than the cost? Step 2, determine whether it's other than temporary. In other words, we don't expect to recover it. It says the investor has the ability and intent to hold it for a reasonable period of time to sufficient for the forecasted recovery of the fair value and evidence indicating that the cost is recoverable. So if you think the value is going to come back and you expect to hold it that long, then don't hit it. But if you don't know if you're going to hold it that long and or it's not recoverable, then you would write it down. And then step 3, record the loss. It says the impairment loss, the difference between the cost and its fair value. So what you would do is just debit, loss, credit, investment. Notice though up until now every adjustment was what? We hit a loss, but we didn't hit the investment, we hit an allowance, 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 allowance. Okay, that's what we've been doing so far. So stay this way, we're only on this. There we go, okay? So that's what we're looking at. So that's this part here. Okay, so that's what we're saying where it's just a kind of a temporary loss. Here we're talking about a non-temporary. All right, next area talks about reclassifications. With reclassifications, that's where we're reclassifying between what? One category and another. So when reclassifying, here are my three categories. So in my three categories, I have trading, available, held to maturity, held for trading, available for sale, held to maturity. If I go from here to here, here to here, here to here, here to here. So you may reclassify. Why? Based on management's intention. Management goes, you know what? I think we're going to do this or this or this. That is called management's intention. Now, when you reclassify, basically if you touch the word trading, you go from here to here, here to here, here to here, here to here. If you touch the word trading, fair market value, gain or loss, income statement. If you go here to here, here to here, then gain or loss, fair value, balance sheet. So that's a good cheat sheet, quick way to remember it. If you look in your notes, it says reclassifications. It says if you're reclassifying from trading and available, between trading and available, it says fair market value, the difference is treated as a realized gain or loss on the income statement and eliminate any valuation allowance. Reclassifications between held to maturity and AVS, reclassify at fair value. If held to maturity to AVS, then record OCI. If AVS to held to maturity, then the unrealized gain or loss goes on the balance sheet, and then it's amortized over the life of the security. Okay, held to maturity, I said those are bonds. You have to have the intent and ability to hold it till it matures. There's a whole bunch of things, non-current, bonds, recorded cost, carried amortized cost, unrealized gains or losses shouldn't happen, realized gain or loss shouldn't happen but could, and so forth. So again, I'm going to talk much more about this when we hit the bond chapter. All right, now let's look back up here one last time at my chart because it's a beautiful chart. I want you to remember this chart. Trading, available, held to maturity. Trading, generally current. It could be stocks or bonds. Unrealized gains or losses go to the income statement. Realized gains or losses, income statement. Interest dividend goes to the income statement. And of course, it's generally an operating activity on the statement of cash flows. Let's talk about this one, available for sale. It says current or non-current, stocks or bonds, fair value, but the big difference, this comes up here, which means unrealized gains or loss go on the balance sheet as part of OCI. Same things about what's on the income statement other than unrealized, and generally buying or selling is an investing activity. Held to maturity, current or non-current, usually non-current, bonds only, carried at amortized cost. Buying or selling is generally an investing activities. So again, what you're going to see on the exam most likely is a distinction between these two. So a little bit of change in between these two, which is trading and available for sale. So that's what I really want to make sure you understand. All right, finally, fair value accounting. It mentions here for available for sale securities, for held to maturity, for equity securities. It says here any unrealized gain or loss would be reported on the income statement rather than OCI. For held to maturity, they would no longer report the investment and amortized cost. Instead, it would be at fair value. And again, gain or loss would go to the income statement. So the big difference here is you debit the investment credit cash, and then every year it goes up, income statement, goes down, income statement, goes up, income statement, goes down, income statement. So it makes it a lot easier. That's why you could elect fair value. The way they generally test it is this stuff. So that's why I'd rather have you remember this as far as understanding what and how it all goes together. All right. Some of the disclosures. Remember we talked about disclosures. Those are the disclosures here in the financial statements. We've got fair value. Distinguishable between instruments, and do not net or aggregate the fair values for the derivatives. So that's just talking about some of the different accounting for those items. Okay, let's talk about investments in financial instruments other than entities under IFRS. So this is an important area because there have been a few changes here, different ways that you can value these investments, for example. In looking at investments in financial instruments, it says the term investment refers to investments that are either held for trading, HFT, available for sale, or held to maturity, as well as equity investments. A financial instrument should be classified as either fair value through profit or loss. Now that's kind of weird, fair value through profit or loss. It says fair value, it says includes any financial assets and held for trading, could include AVS and held to maturity if elected and there's an active market. So what it says is you can only use this if there is what we call an active market. And what we mean by an active market is that you can see in the market what the fair value really is. Because if we're doing a fair value through profit or loss, you've got to be able to see pretty readily, pretty easily what the fair value is. It says here, held to maturity instruments with fixed indeterminable and fixed maturity dates, you would show at amortized cost, which is what we already do. Held to maturity or what? At amortized cost, so we already do that. It says here loans and receivables, amortized costs, so you break those out separately. Available for sale, financial assets that do not fall in the above three categories, we would show at fair value, and your gain or loss would go to OCI. Kind of like what we did earlier. So those are, again, some of the big differences there. It says if an asset is classified as fair value through profit or loss, it is remeasured at fair value at the end of each accounting period. Any profit or loss goes to the income statement. An election can be made to use fair value through profit or loss method for accounting purposes for an asset normally classified as AFS or held to maturity. In order to be done, again, it has to have an active market. So that's the key. They like to sometimes ask that, active market. Once you classify that, you cannot change it. So once you make that decision, you're stuck forever. It's like marriage. You're stuck forever. And if you try to get out, you'll be paying for it, baby. All right. It says if fair value to profit or loss is not elected, the different rules apply. The investment is classified as held to maturity. It's recorded at cost, subsequently measured at amortized cost, kind of like what we already do. If classified as loans or receivables, it's accounted for using the amortized cost method. If the investment is classified as available for sale, the asset is measured at fair value, and any income or loss goes to where? OCI, which is what we already do. Note that if a debt is classified as AFS, any premium or discount must be amortized using effective interest method, which we have not learned yet. We're going to learn that with bonds in Fair 3. So what is the overview? It says declines in fair value below cost may result in an impairment loss. For IFRS, generally only evidence of a credit default would affect your AFS, available for sale. When impairment is recognized through income, the new cost basis is established, and you cannot reverse that. So when you have an impairment loss, you write it down. That write down is not recovered. So when you write that down, do not recover. In other words, that is your new base. However, if you have an impairment loss under IFRS, it says here it may be recovered. So that's a big difference too, because we talked about an impairment loss, a loss other than temporary permanent decline. You write it down, you don't write it back up. With IFRS, you write it down, but you could write it back up. Unless the fair value option is elected under US GAAP, loans and receivables are classified as either held for investment, which is measured at amortized cost, or held for sale, which is lower of cost or value. Loans and receivables under IFRS are at amortized cost, unless you choose the fair value through profit or loss, or the available for sale category, both of which are carried at fair value. So again, not huge differences, but enough where you could easily see a multiple choice question or two. All right, let's look at a couple of questions here. Look at question number 7 about IFRS. It says on March 1st, Acadia purchased 1,000 shares of common stock of Marston for $50,000 and classified the investment as available for sale. On December 31st, the Marston stock had a fair value of $53. Arcadia prepares its financial statements in accordance with IFRS, and they elected the fair value through profit or loss to record its investment and available for sale. Now remember, normally, where does your AFS go? Available for sale goes where? Normally it goes here, OCI, balance sheet, part of equity. Okay, that's where it normally goes. However, if you choose the fair value through profit or loss, then that gain or loss goes where? Income statement. It says, how is the gain on the investment shown? As a $3,000 gain in OCI? No, that's if you did available for sale normally. No gain or loss? No. $3,000 prior period adjustment? No. That's a correction of an error, which we haven't learned. As a $3,000 gain on the current earnings? Yes. In the income statement? Answer D. Debit allowance, credit unrealized gain. All right, number 8, under IFRS, if a company uses the fair value method for accounting for an investment, any changes in fair value are recognized where? Well, we just did that. Where? Profit or loss. OCI, no. Retained earnings, no. Profit or loss, yes. Why is it? What's it called? Fair value through profit or loss. All right, what I want to do now is I'm going to do a simulation problem, but we're going to do that in just a second.